Hi, welcome to Phil's Gang YouTube site. My name is Phil Grandy. I do a nationally syndicated radio show every day from 3 p.m. to 4 Eastern Time. And this is my YouTube site, of course. And I'm going to explain to you this is my third part of a four-part series. The first series was on April 3rd. The second one I did on April 17th, explaining what is the future, what's going to happen, what's the market going to look like, what are you going to look like, the economy. So let's start with a little review. Okay. Now remember, anytime during this program, you go to my site, philsgang.com, you get a 10-day free membership. Just where it says get started, and you can join the gang by getting started right there. That's all you do, get started, and make sure you sign up for the Working Investor Group, and then you can be with us for 10 days free using the site. Okay. The stock market crashed. A little review in 2008. Usually, what they do is they go into a recession. When you go into recession, that's a good thing because you clean up, get rid of all the bad company, all the bad management, and you reallocate the assets from the bad to the survivors. And you also have money to go to startup businesses. Startup businesses are the backbone of our country, provide 72% of our employment, and it's the startup businesses that grow the economy. That's what's important to remember. But our owners of the Federal Reserve, which is no more federal, has reserves nothing. 28 of the richest people in the country control the Federal Reserve. It's a bunch of gangsters. It's a cartel of banks, and they decide on the interest rates, and they print money. So the first thing they did in 2008 to prevent a recession going down, they had to print some money, get rates down. Why? Well, when they print the money, they buy 10-year treasuries. When they buy the 10-year treasuries, that drops the yield down, and that then sets off where the Federal Reserve, which they control their own rate, the short-term rate, then they turn around and they can drop their rate. That's a good thing. You're familiar with the Fed rate because that's the rate that affects your car loan, affects your school loans, your credit cards. So that by printing money, buying the 10-year treasury, that drops the long-term yield down, which drops the short-term yield down, which gives you a break on all your interest rates and credit cards, everything you do. So they keep printing and printing that money. Why are they doing that? Well, as I explained in the last two series, because when they print the money, they give it to the banks, and the banks give it to the companies. Now, you notice the banks and the companies have little flags on their building. That's to remind us they're patriots. No, they're not. But that's why you always see flags on their building to fake us out. So once the Fed prints money and the rates are low, they loan money to the banks, which loan it to the companies. Now that's very important. Why? Well, because in 2008, remember, earnings come out every quarter. And if the earnings are terrible, that means the stock market's going to crash. So they did some financial engineering to make sure that didn't happen. With that printed money they give to the companies, remember how earnings work. At the end of each quarter, you take your earnings, let's say it's 4%. You always got to have enough earnings to spread over the amount of shares you control, which are 14 million shares, we'll say in this case. So if you have 4% earnings spread over 14 million shares, you're in good shape. The stock goes up $5. But what happens after the crash? The earnings coming out was going to be 3%. Well, you can't spread, if you spread 3 million shares over 14 million shares, you're going to end up going down $4 or $5 the stock. That's not good. So what do? You simply take the money from the Fed, and the CEO will buy down the shares. So he'll knock them down to 13 million shares. So at 3%, even at 3%, now he's got enough money at 3%, and he looks at 13%. Oop, no, it still will go down. So they borrow more money from the Federal Reserve, and they buy their own shares to drop it down to 12%. Now, 3% over 12% works. The stock goes up $5. So the idea behind this is whatever your earnings are, you can financially engineer it that your stock never goes down by buying down the amount of shares you need to have the earnings override those shares. So if you go down to 2% earnings, they give enough money. They figure out, okay, if I got 2% earnings, I got to drop the shares now to 10 million. So that's how they always keep the stock price going up. It used to be a felony, of course. It doesn't make sense. Reagan stopped that. Now the problem with that the Federal Reserve has to buy all the garbage from the old companies to make them survive. They take all their bad assets, they buy their treasuries, they buy their accounts, they buy all their garbage, and they put them on their balance sheet. And when they put it on their balance sheet in 2008, their balance sheet was only 400 billion. Okay, then it went to 4 trillion. And I say, well, how does that affect me? Well, that means as the debt goes up of these corporations borrowing all this money, okay, your dollar goes down. The more they keep on printing money, the more your dollar goes down. That means you need 2 pieces of paper, okay, to buy what you bought a month ago with 1 piece of paper. So if you bought a candy bar with $1, the next month you need to have $2 to buy that same candy bar. That's inflation. As a result, our budget deficits go up because the government keeps borrowing money more than they're taking in, and trade deficits go up. So it really kills the economy. So, but the fake business news networks would never tell you any of this stuff. They tell you everything is wonderful because the stock market's going up. And they're going to tell you the stock market tells you how fine the economy is, when it's just the opposite, okay? So by 2015, okay, everything was rocking and rolling, but earnings were collapsing. And so wasn't economic growth. So we had a stock market going up, okay, about 300%, but the economy is only going up 2.9%. So if you're going up 300%, the stock market economy is going up 2.9%. How does that work? Well, it's not. That means your economic growth is failing, your earnings are failing, but they don't tell you that. They keep saying, oh, look at the stock market, because remember what their trick is. As long as they can get the Fed to print enough money to give to the company to keep lowering their earnings, okay, I mean, whatever their earnings are, to keep purchasing the amount of shares they have, to always make sure the stock goes up. So this is called a bubble. By 2018, the debt was so heavy from all this borrowing, the market started to crash. Now, that was in 2018. The market went down about 20%. That was September 2018. Remember, I predicted it on January of 2018 that it would happen. So how'd they get the market to go back up again? Well, they had 2 things going for them. One, they got the Fed to print more money and to buy the 10-year Treasury down and put the Fed rate down to near zero to give it to the banks loan it to the company would keep reducing the amount of shares they need to keep pushing up the stock price. And they also had what they call, hey, we're going to sign the trade deficit. We're going to sign the trade deal with China any minute. That's all they did. And everybody bought into this is going to be fantastic. They keep buying in. You always buy into the rumor. Well, everybody bought into the rumor they're going to soon have the trade tariffs completed. They're going to come up with a deal with China. By 2020, though, we had a problem. The debt was so huge now, okay, and the debt was so huge that the economy was so weak, it finally collapsed, just like in 1929. And so that's where we are today. Now, they tried to move the market back up. Remember, we went down about 33%. They moved the market up about 28%. And how did they do that? 5 stocks did that, okay? Those are called your FANG stocks, all right? So the FANG stocks, remember the FANG stocks, those 5 stocks, okay, is what drove the entire market up from 2008, okay, to 2020. They were over 33% of the stock market gains, the FANG stocks. Now, the FANG stocks, again, started to move the market back up. Remember, the FANG stocks never went down. They moved up through the 2008. After the crash, they moved the market back up again. It was only the FANG stocks that moved the market up and the stock buybacks. We created the biggest bubble in the world. But here we are with the FANG stocks right now. Okay, they're moving the market up. But there's a problem with the FANG stocks moving the market up. You got to have the banks got to lead. And when the banks don't lead, the banks aren't leading, but the FANG stocks are. The minute the FANG stocks start dropping, then you know the market's going to crash. As long as the bank stocks aren't leading, they're dropping, which they are, and the FANG stocks start breaking, then the market is going to collapse again. So the key is what is going to happen between now and trying to get back to test the highs up here. Will the FANG stocks keep dropping, Will the banks not lead? Well, if that happens, the FANG stocks drop, the bank stocks don't lead, then we're going to get another crash, and we're going to test these bottoms right here. Okay? So the banks are the key. Keep an eye on your bank stocks. Keep your eye on the FANG stocks. Again, if the FANG stocks drop before the bank stocks can accelerate, then we're going to test the bottom. You get it? Pretty easy, isn't it? Okay? So that's what you watch your FANG stocks. All right. So that's the end of my third segment of a 4-segment process. So here we are. We'll see what happens now as they are trying to push the economy open. Everybody thinks, okay, everything's going to go back normal with the economy opening, which is a bunch of BS. Nothing is ever going to go back to normal when you have 23 million people out of work, okay? The banks, remember, are the key. Banks can't make money. They can't make money, not with near zero rates, with 23 million people out of work, even if you bring them back together. So if you're just patient, even opening up all these businesses, the highest probability is the market is going to crash again. It's going to test the bottoms because you've got to have the bank leadership. And the banks can't make money in this kind of low interest rate environment. So keep your eye on the banks and the FANG stocks. I'll see you on the charts again for the final version of my take on what's going on with the market. Remember, join my gang, philsgang.com. It's free for 10 days. You'll get your color-coded chart and your membership free for 10 days. Remember, it helps St. Jude if you start making money. See you on the charts.